Hi, Apeksha.
Hi Bhakti, how are you?
All good. How are you?
Good, thanks.
Hi, Rashmi. Hi, Asim.
Hi everyone.
Yeah, hi. Hi, everyone.
Hi everyone. Hi Apeksha. Hi Asim. Hi Bhakti.
Hi.
Wasim,
Yeah, tell me.
should we start or we want to wait?
No, I think let's start. 11 to, I can see 11 people. So I
Mhm.
think we can start.
Sure. Okay. So
You can start with the intro. Yeah.
yeah. Yeah. Hi Apeksha, how are you? Hi Nikhil.
Hi, Rashmi. Hi.
Yeah. So welcome everyone. We have Apeksha and Nikhil with us today, and they'll be taking us through the BACKSOLVE method, which is I think by far the most sought after and complicated requirement as far as valuation is concerned. Before we start, I'll briefly introduce Apeksha and her colleague Nikhil. Apeksha Kukreja is a valuation professional, and she is a director with PwC's valuation team. She's been with PwC for around 15 years now. Apeksha is a graduate in commerce from Calcutta University, and she's also an associate. She's a member of the Institute of Chartered Accountants of India since 2005. She's also an All India rank holder in both CA Inter and CA Finals. She has passed examinations conducted by Chartered Financial Analysts USA and Global Association of Risk Professionals. Mainly, she focuses in the areas of mergers and acquisitions, which involve business and equity valuations, valuation of intangible assets and PPAs, taxation and regulatory valuations, and bid advisory. She has immense experience in the valuation of complex derivatives and financial instruments, as well as modeling. Apeksha is a regular speaker at seminars and workshops conducted, by various forums, including the ICAI. Hi, Nikhil. I'll briefly introduce Nikhil as well. He is a manager in PwC's valuation team, and he has experience of around 8 years in the field of financial instruments and derivatives valuation. Nikhil has recently joined PwC, and he earlier was with Deloitte and SS&C. He's an IT engineer and MBA finance from Mumbai University. He has also passed his FRM examination conducted by a Global Association of Risk Professionals USA. Nikhil focuses in the area of valuations of financial instruments, derivatives, reviews, and development of financial models, business and equity valuations. With this introduction, I'll now, like to request on behalf of the Valuation Study Group, to help us all, with this complicated method today, complicated backsolve method and valuation methodology. Thank you.
Thank you, Rashmi, for the introduction. And hi, everyone. Good afternoon. Given that it's a small group today, I think the way we can go about this session is that uh, I'll speak briefly about the backsolve method, advantages, disadvantages, and we have one example, which is more like a theoretical example, and two complex case studies which we have conducted during the course of our engagements, which we can take up. Feel free to put your questions in the chat or interrupt us as we go, because that will make this more interactive, and we can also get a sense of whether whether the audience is receptive to the explanations which are coming from us. So that will also help us answer your questions better. With this, Nikhil, can I request you to present your screen and put up the presentation, please?
Sure, I will do it. Can you hear me clearly, but
Yes.
okay, sure. I'm just sharing my screen. Let me know if you can see.
Nikhil, make it full screen now.
Yeah, just
Increase the visibility.
Hmm. Is it full screen?
Since you're presenting your screen, maybe it is showing in the it's showing in the
Uh,
display setting mode.
okay. Just
Maybe we can go back to this, and if you can increase the size. Yeah, try that one. Try the slideshow. No, not really. Go back.
Not
Sorry, bear with us. We're just trying to figure out the best way to present this.
okay in that case. Let me share a window. Check now.
Yeah, this is better. Thanks, Nikhil.
Okay.
Thank you. Everyone, the screen is visible. We are audible.
Yes.
Yes, Apeksha.
All right. Nikhil, go to the next slide, please. So today, what we are going to cover, I have already discussed this very briefly. What is backsolve method? What are the advantages? How do we use backsolve method? We will cover this through an example, and then we will take you through two case studies which we have carried out as part of our regular engagements in the valuation practice. And then we can have a session of Q&A. Having said that, please feel free to put in your questions in the chat box, and we will take it up as we go. Nikhil, can we go to the next slide? So, what is backsolve valuation method? In very simple terminology, it's a goal seek function that we use considering the most recent transaction value as a key input. It is essentially arriving at the value of equity, having known the value of the most recent round of funding. Now, this is while it's a complicated method, it's also open to subjectivity. It is usually preferred to value companies which have complex capital structures. Companies which have various categories of preference shares, convertible debentures, even optionally convertible elements, and ESOPs, warrants, where it is not a simple function of taking the transaction value and dividing it by the stake purchased to arrive at the value of the overall entity. In a lot of tech companies, startups, or even more recent cap structures that we see, you will find various categories of instruments. In that case, using a fully diluted equity base to value respective preference share categories may not be the most ideal solution. In those instances, the backsolve comes as a very handy method because it ascribes the value to each different tranche considering various factors, some of which may be the liquidity, the preference, right of participation, or any conversion element which may be there in that particular instrument. It's recognized for valuing the equity compensation in a privately owned company. This method is also very highly recommended by the AICPA guidelines. And while within the Indian context, there are not, this is the adoption of backsolve is a relatively nascent phenomenon. I mean, it's still very early days. And you may not come across very many engagements where backsolve may be the primary method of valuation. But in the US context, this particular method is prescribed for both financial reporting and for tax requirements. So, particularly in the US context, very quite often the tax valuations may require backsolve to be adopted to value, various series of preference shares which a company may issue. So, backsolve from that perspective, using on one hand the price of the most recent investment um, for a particular series of preference shares or series of instrument, and using that to arrive at the value of the overall entity and allocating that between different categories. That in a nutshell is the backsolve valuation method. Nikhil, if you can go next slide, please. What is an option based valuation method? Now, it's a popular and commonly used method to allocate equity value to securities in a complex capital structure. And this is based on the idea of an economic relationship between classes of securities. So one can look at different series which may have been issued by a company as a call option available, which will be exercised when the value of the company exceeds the amount which may have been subscribed for that particular series. So, in this particular method, we try to arrive at various value bands over which the holder of a series would exercise the option, and if that particular level is not achieved in the value chain, these options will not be exercised. In that case, the holder may fall short of the principal which they may have invested, and if it goes beyond that, then how the value is allocated between the different preference classes. So that is what we call the economic relationship between the different securities. Now, it is also used to determine the equity compensation with conditional economic features. It is most appropriate to consider for this method to be considered in valuation of companies which have a longer liquidity event timeline or have multiple exit options. Some of the exit options that we typically see would be IPO scenario or acquisition by a competitor or any drag along or tag along kind of clauses. So where there may be different options to exit at different points in time, this method may find better application. The model works very well in valuing the principle behind it is that the option has a payoff. If the value of the company exceeds the value at which one has invested in it, then only will the holder of the series be willing to exercise it. That is the principle behind which backsolve method has been built. Nikhil, can we go next, please? Understanding the OPM backsolve valuation method. So OPM backsolve is based on the principle that an economic relationship exists between various classes of securities. This relationship is nothing but the hierarchy in which a holder of a series may exercise their conversion element versus that of another. So when the value is allocated between different categories, in what proportion would the participate in the value chain having recovered their principal invested is the way to determine the economic relationship. This will be better explained in the examples that we will look at. Essentially, we are trying to say that different series may exercise their options at different points in time. The first step would be to recover from the value whatever principal has been invested. Once that principal has been recovered or allocated, whatever excess in the value remains after the preference subscription amount has been taken out, the balance how that is allocated is the economic relationship between the various instrument holders. In a lot of cases it is pari passu. In a lot of cases there may be a clear ranking based on which the or participation rights based on which series holders will be eligible for claiming a share in the value, and this is the economic relationship that I'm talking of. uh, and this relationship will exist because there are differences in exercise price, required return, conversion option, liquidity preference, or participative rights, and each series may have a different term attached. Now, these rights will determine the amount, value, and order of each class in the allocation chain. Now, when the value of a single class of equity is known, this method will provide the ability to determine the value of all the other equity related securities by doing a back solve, by back working. So it is to say that if the latest series price is known, and we also know the relationship, the economic relationship of this series with say the previous series which may have come prior to this particular current series, what is the allocation of value? So it is solving an equation where x and y are known. X is known, y is the relation between x and z, and hence backworking z using this mathematical derivation. Nikhil, can you go next, please? The advantages of using a back solve: it establishes a value for equity compensation based on the latest financing round. The latest financing round is a known fact. It's factual, so there is no ambiguity around or any subjectivity around determining the value of the most recent round. And given that the economic relationship between securities can also be established, which is also based on agreements, this may be a more scientific way of allocating the overall equity value of a company to its various equity category classes. It's extremely useful to value equity compensation in portfolio companies, particularly for private equity and venture capital investors. And it is well suited for companies with complex capital structures with multiple categories of equity ownership. Uh, with this, I will request Nikhil to take us through an example of how backsolve method is adopted or implemented rather.
Thank you, Apeksha, for the brief introduction on the BACKSOLVE method. Now, hello everyone. So, lot of theories. So now, in order to understand how the BACKSOLVE valuation works, it's better to work with an example so we can understand how it's actually working in our Excel model. Take an hypothetical example. There are 12 million common shares which is issued by the company. 1 million ESOPs at a strike price of $0.1. 2 million ESOPs at the strike price of $0.15 per unit. Suppose the recent funding round of common shares happened at a price of $0.2 per unit, then what is the equity valuation of the company? This is under the presumption that the recent funding round has happened at the arm's length transaction of $0.2 per unit. So the first step in the BACKSOLVE method is to understand the capital structure of the company. As I said earlier, there are 12 million common stocks, which represents the equity. Then there are dilutive instruments, which are ESOP 1 and ESOP 2. The number of ESOPs, 1 million with a strike price of 0.1 and 2 million with the strike price of 0.15. Here it's the percentage ownership without the dilution, and the last column represents the percentage ownership with the dilution. Accordingly, there are total number of outstanding shares post dilution around 15 million. And based on this capital structure, our next task is to arrive at a break-even point, or is called as waterfall analysis. Now, the first step in waterfall analysis is to look at the payment to each of the asset classes, starting with zero. Suppose the enterprise value or the company valuation is zero. No one would get anything. Then the common stock would participate. The number of common stocks are 12 million, as discussed in the capital structure. They would start participating at zero price. After the common stock, the ESOP guys would participate. The number of ESOP 1 is 1 million. So the total number of outstanding shares that would participate in this waterfall is previous 12 million plus the 1 million of ESOP 1. So totaling around 13 million ESOPs. And they would start participating at the price of 1.2 million. And how this 1.2 million has arrived? Look at here. It's the total number of outstanding common stock multiplied by the strike price. And from this, you minus the number of ESOPs multiplied by the strike price. The reason of deducting this amount is because this is the cash proceed that a company would receive when the employees would exercise the option. So it's not appropriate to include that. Hence, we deduct this from our break-even point. Moving on to the next point, waterfall analysis. The ESOP 2. In ESOP 2, the total number of participating shares would be the previous number plus the 2 million number of ESOPs with ESOP 2. So the total number of participating shares was the 15 million, and their breakpoint would start at 1.95 million. And how it's computed, like we did for earlier point, it's the total number of outstanding shares multiplied by the strike price of the second ESOP, which is 0.15. And from that, you deduct the cash proceed that is received by the company due to exercise of that ESOP. So hence you get the third break-even point. Anything over and above, all will participate in this.
So one question, Nikhil, means how did we arrive at this 1.95 million? I thought it should have been for the first ESOP one, it should have been 13 million minus this 10,000, right? Or means how did we arrive at 19.5 is something which I was not able to understand.
Yes.
So Bhakti, with each round, the number of units will keep increasing. So at the breakpoint of 15 million, when it is assumed that the earlier units have already been converted. So 15 million becomes the total number of participating shares.
Right.
At a and if so, one way to look at it, so this is ESOP is just a nomenclature. It can be any series also. So this 0.15 is the exercise price or the price at which you have infused. So we are trying to determine that what is the value over which you will be keen to convert, provided that you have invested at 0.15.
Which is this 19.5, which is the last one.
Correct.
Now for the second one, ideally it is 13 million with a price of 0.10, right? So that works out to whatever. I'm just confused with the second one. How there it became 19.5.
Okay, so it's a band. One should look at it as a band, that up to what point will you be participating before somebody else gets a preference to participate. So 19.1, really speaking, is a collective number which considers all the parties who have so far come into the value chain, of which 1.2 million is ascribable to the first tranche, which is the common equity. The second person has come in at a pricing of 13. So 13 to 19.5 he's going to take, and anything beyond 19.5 without having any consideration of liquidation or participation, not like that. It's a very simple example right now where we say that 19.5 and above the 15 million guy, or I mean the incremental which comes in at that point in time, will be keen to participate. So we are just trying to ascribe in a way strike price over which you will take a punt on the company and exercise the option that you have.
Got it.
Nikhil, before we proceed, there is a question from Rajiv. He has asked whether the latest financing round is applicable or near future as well. So, Ravi, in this case, one should ideally consider the post money value implied by the latest round of funding. So one is the price of the recent funding that you would consider. Say if your ESOPs have been the series has been issued at $250. $250 per unit is the price for which you would goal seek the overall equity value, such a way that you end up with 250 in the final allocation per unit for this particular series, which is our starting point. A lot of times there is a confusion whether one should use the pre-money value or the post-money value at an overall entity level. But one should always consider the post-money value, because once a transaction has happened, the pre-money value loses relevance. Nikhil, do you want to speak about our latest experience that we had, or do you want to do this once we have gone through the example?
Yeah, I think that would be better if we once go through the example, because right now we are in the middle of these steps.
Right.
So if we break the chain in the interest of other participants, it will just lose the context. That's why.
Sure. Ravi, may I request you to put your question here in case I've not already answered it?
And one more thing, Apeksha, because since I'm sharing my screen, I'm not able to get all the pop-ups or the messages.
Don't
So
worry,
just
I'll keep a check. No problem.
yes. So so I think that answers your query. But having said that, there are two more case studies wherein if this is not clear, we would be able to better explain you how we arrive at each of the breakpoints, since we will go through an Excel file wherein you might be able to look at the actual computation that is happening. But having said that, this is the simplest break-even point that we have arrived. So uh, now, this concludes our second step, which is the waterfall analysis. Now, based on this breakpoints, or you say the start points, or you say the exercise price for each of the asset classes, you compute the call option value for each of the options. Now, the basic input of this call options are the first, the underlying price, the equity price. The starting equity price can be any random number which you insert, because at the end of the day, your purpose is to find this valuation, the equity valuation of the company. So you can start with any random number. Uh, the strike price is the break-even point that we have arrived earlier during our waterfall analysis. For the option one being uh, next to 0, for the option 2 being around 1.2 million, and for the option 3 being 1.95 million. Uh, the remaining tenor we have assumed is 3 years for this example. The risk-free rate as 2%, dividend yield 0, and volatility of 45%. Based on that, the internal computation of the Black-Scholes model, the D1, D2, and D1 and D2, and accordingly, the fair value of the call option per share we have, sorry, it's not per share, it's the total. We have arrived as 2.6, 1.6, 1.1 based on the economic inputs that we have used. After that, you compute the incremental value of each option. The incremental value is nothing but your option 1 minus the option 2. It's your incremental. For option 2 is the option 2 minus the option 3. For the option 3, since there is no other option, is equal to the option 3. And after this, what you compute is the percentage allocation for each of the asset class. Hello?
Hello.
Yes. Hello?
Continue, Nikhil. It's all right.
Okay. So after computing the incremental option values, you compute the percentage allocation. What you see here is the percentage allocation to each of the asset classes. Now we have 3 asset classes, which are common stock, ESOP 1, ESOP 2. And accordingly, the number of the common stock equivalent of each of the asset classes as per the capital structure, 12 million, 1 million, and 2 million. At the price of ESOP 1 has a price of 0.1, ESOP 2 has a strike price of 0.15. Now, suppose the common stock has participated. So in our first option, the common stock participates, the ESOP guys don't participate. Hence, they have a zero value. In the second option, the ESOP 1 also participates, which equal to 1 million. This is under the conditional probability that the common has already participated. Hence, the common would also participate. There would be also ESOP 1 participating. ESOP 2 are yet to participate. Then you go to the ESOP 3, ESOP 2. In ESOP 2 number of ESOPs would also participate under the condition that ESOP 1 has already participated. This is under the condition that the common stock has already participated. So accordingly, this is the percentage allocation table. And using this percentage allocation table, you will compute the value allocation for each of the asset class.
Nikhil,
Now
just
this
go back one slide. I just want to ensure that everyone is on the same page with us. Any questions so far? Is there any concept here which you would want us to re-explain? Okay, Nikhil, go ahead, please.
Yes. So this is the last
Just
step
one
of our
question.
back. Yeah, go on.
Just a small point. So when we were referring to the fair value of options there for the incremental tranches, we are referring to the option available to those specific series, right? Let's say it's prefer series A, preferred stock, option ESOP 1, ESOP 2, right? The incremental
Yes.
series that we're talking about based on the
Yes.
breakpoints.
Yes. Yes. So this
Yes.
option 1, 2, 3 that you see is nothing but the waterfall
Right. Yeah.
analysis serial number 1, 2, 3.
2, 3. Yeah. Okay. Yeah.
So
Thank you.
option 1 represents the event of common stock participating. Option 2 represents the
ESOP. Yeah.
ESOP 1 participating, and option 3 representing ESOP 2 participating.
Yeah. Yeah. Thanks.
Okay. So the last step of the backsolve method is the implied equity value. So based on the previous slide where we have computed the percentage allocation, asset allocation, using this you will compute the value allocation for each of the asset class.
This is to be looked at horizontally, because if you see vertically, it will not total to 100. So at an incremental value of 1.04 million, only common stock will participate. With an additional incremental value of 455,000, common stock and ESOP 1 will participate. So it's a horizontal representation of who participates in the incremental value created, such that the total of the value is 2.6, which is the overall value of the equity.
Correct. So further, for the ESOP 3, since all the asset class would participate, which would represent the 80%, 6%, and 13% in total, and their incremental option value is 1.17 million. So just to give things more in prospect, this option 1 incremental value is this. The option 2 incremental value 445 is here. Option 3 incremental value 1.17 is here. Moving on to the percentage allocation, like in the previous table, in the first part, the common stock would participate. So that's a 100% participation. None other would participate along with the common stock. Hence is the 100% and 0 and 0. Then at the second at the second option, it's the common stock plus the ESOP 1 who would get participate. So the total number of outstanding ESOP would be 13 million. And hence we have divided the 13 million between the common stock and the ESOP 1, and ESOP 2 having 0% allocation. This percentage allocation is, say for example, the 92 is 12 million divided by 13 million, you will get 92. And the 1 million divided by 13 million, you will get 7.69. Similarly, for the ESOP 2, the common stock will represent the 80%, which is 12 million divided by 15 million, the 15 million being 12 plus 1 plus 2. Then for ESOP 1 is 1 divided by 15, and for ESOP 2 it's 2 divided by 15. And hence you get this percentage allocation. The value for each of the asset class is the sum product of your percentage allocation that you have arrived, multiplied by the incremental option value that you have arrived at. So 2.4 million is nothing but 100 multiplied by 1.0, 92 multiplied by 4, 4.5, 80 multiplied by 1.17. Accordingly, you will arrive at the value allocation of the common stock. Similarly, you will compute for the ESOP 1 and ESOP 2.
This is
This is
nothing but a sum product of the incremental value call option and the common equity, or the ESOP 1 or the ESOP 2 respectively. The 2.4 million that you see where the cursor is right now. So it's a sum product of the value in each, or rather the participation of each category of instrument in the incremental value created at each breakpoint, such that the total value ascribed to the instrument on various point at various value points in time is what the sum total will give us.
And just as a cross check, the summation of all the three value allocation would match the total number of equity price, the random number that you have used at the total, the equity valuation. So basically you are just splitting this total equity valuation across the asset classes. The total number of shares, the number of shares as per your capital structure, 12 million for the common, 1 million for the ESOP 1, 2 million for the ESOP 2. And hence you arrive at a per unit value, which is nothing but your value divided by the number of shares. And hence you arrive at the per unit value for each of the asset class. The final step of this computation is, since we know recent funding round of the common share was priced at 0.2. So we know the known equation part, the 0.2 has the latest transaction price, such that we will back solve at what valuation your per unit common stock would equal to $0.2. And hence you will back solve the equity valuation, which is nothing but your random number that you have used initially, such that your per unit value for the common stock is equivalent to your latest transaction price, which is 0.2. And hence you will arrive, or I would say you will back solve the equity valuation based on the latest transaction that's happened.
So very simply speaking, in the Excel, once we have the equations worked out of the break, the equations for breakpoint, and we have this table worked out, the brown 2.67 million that you see, the brown cell is goal seeked in such a way that the value in the yellow cell is 0.2. So in the earlier example which I spoke of, we know X, we know Y. Y is the relationship between X and Z, and we have to work out Z. In this example, Z is the 2.67 million that you see. We know X, which is 0.2, and the break-even points are the relationship between X and Z. And we have worked out 2.67 by using the goal seek function in the Excel, such that the value of the common stock by this equation is $0.2.
So, Apeksha, do you mean here that this goal seek number of 2.67, what you have worked out, ideally your DCF value, which may have been worked out, also needs to come to this number?
Yes, Bhakti. Ideally, yes. It may happen, it may not happen. You may not end up with the exact same number, but it should broadly be in the same
Same range.
value range. So I'll give you an example. We were valuing a edtech company. It's a leading edtech platform in India. And for a very long time, we have used BACKSOLVE method to value the various classes of equity. And the overall equity value which would work out using this this entire process, we would try to benchmark it with the discounted cash flows available. Most of the times we were successful, but as and when the cap structure became more complicated, establishing this sort of a relationship, there would be a divergence from the DCF value. That's a practical constraint that we
Yeah.
live with.
Yeah.
Now, this cap structure which I'm talking about is really complicated, and different investors, depending upon their stake in the company, may or may not have access to relevant information. So, with a given set of data points which a minority private equity holder may have, with no representation on board, those kind of practical challenges, one can try to work this. But if you have the best information available, the value which you get here should ideally tie back broadly to the DCF which you will get.
Or so in one of the cases, the way I had seen, right? So whatever the recent round of funding had happened, and we tried to do goal seek. Okay, the DCF valuation was say 100. But the moment I was trying to do a goal seek, actually, so 100, which includes the infusion which has happened, right? The infusion which had already happened
Right.
was, and then 100
Correct.
had come.
Yes.
Now the moment we tried to do a goal seek, actually the goal seek number was coming below 100. And that's where I would just ask this question, maybe not practically here, it is a simple example because you've just considered ESOPs.
Right.
But when we go into the complicated real life, you have different preferred stocks with different liquidation preference, different terms, tenures, and conditions, where not every time it is possible to come to the same conclusion to say that what I've arrived based on DCF and what the goal seek number may throw up, it may not necessarily reconcile. So in such
Right.
cases, do we then say that, okay, we take the DCF value and then allocate it rather than trying to reconcile the latest equity round of funding?
So, Bhakti, two ways to think about it. So, one is, again, very recently we were looking at, and this was for our audit assist function. We were looking at a report where the value which we were getting from the latest round was not stacking up to the fully diluted value implied by the transaction. In that case, while the value difference was 10% or so, 10 to 12%, absolute numericals were not very high. Like, it was a 10, $12 million difference. But when you see as a percentage of the overall value, it was a difference of more than 10%. We
Yes.
decided to go ahead with our goal seeked number because that was more representative, saying that a fully diluted stake, will not be able to capture the differences in the various classes, which is a negotiated position.
So
Somebody
basically, we are trying to say that instead of a DCF, I have done a valuation based on the PR, price of recent investment
Yes,
method, is something
yes,
replacing the DCF with the price of recent investment.
absolutely. Absolutely. Nikhil, do you want to add
Correct.
more to this? Because you actually worked on it.
Correct. So this is one of the acceptable methodology of arriving at the equity valuation. As you rightly said, the PORI method, the price of recent investment being acceptable methodology. The reason being the backsolve incorporates the economic relationship between different asset classes, which somehow the DCF might not able to take into consideration. And this rights are particularly with the preferences. You name the rights like participation rights, the conversion rights, the liquidation preference, which might not be able to clearly you can account into the traditional DCF valuation. So hence, I would say the PORI method does have a upper hand. And if you look at the international standards, in the India, I see it's more on a nascent stage. But if you look at the international market, mainly US, they have a regulatory requirement of doing a backsolve valuation method for their taxation purpose. So this is, I would say it's you can have multiple valuation, but it's always good to have the latest transaction and then having it cross verified with some other method to arrive at a same range of valuation.
Just one more question is when we arrived
Bhakti,
at this, yeah,
just let
sure.
me complete that thought. I had said there were two approaches, two ways to look at it. So this is the first one that we went ahead with. There can also be an argument to say that in situations where all the preference shares are pari passu, does it really make sense to have this kind of an allocation? So there have been instances where we have gone with a fully diluted stake, because there may be, from the client's perspective, there may be other protective rights which an equity holder may have. So I have seen both being accepted, but like Nikhil pointed out, that in more developed markets there is a preference for backsolve because it is based on PORI. And at the end of the day, both the multiples approach and DCF are lower in ranking as compared to PORI. So both are, I've seen both in my experience, but there's more recently than not, the preference to adopt backsolve is better as compared to simply doing a DCF or a multiple and then dividing the value.
Understood. Just one small clarification is on this value of 2.67 million which we arrived. what I understand, this 2.67 million will also include the cash flow by way of ESOP 1 and ESOP 2, right? It's the value after dilution of ESOP 1, ESOP 2. So it includes that amount. So if we have to look at if the ESOPs were not exercised, then obviously 2.67 minus the ESOP cash flow needs to be reduced, right?
Yeah, so this is the most, it's the post money value
Post
implied
money
by the
valuation.
most recent
Money, yes.
transaction. Yes.
Understood.
Because again, this is a very common error. Nikhil, you want to speak about it because you encountered in this engagement that I was talking of earlier.
Correct. So see, normally what we see across is when you arrive at this waterfall analysis, okay, uh, people only compute the first part and they don't tend to do the second part of this computation, which is the cash flow, which is supposed to be received by the company in terms of exercising the ESOPs. Okay. Now, if you don't include subtract this in your break even analysis, okay, it's like you are overshooting your break even. Means you are double counting at a break even point, because uh, this break even point would be arrived only when an ESOP would get exercised, and hence this is one of the observation that we looked across our valuers, that they do this common mistake. But having said that, this is one of the necessary step wherein you have to deduct this amount, which is the amount received by the company on amount of exercising of the ESOPs by the employees.
And Nikhil, Bhavik this side, I have a question. Can I take it up now?
Yes, Bhavik, tell me.
Yeah. So Nikhil, in case when there is no recent round which has happened, and let's
Mm-hmm.
say you are doing a fair valuation, and the
Mm-hmm.
recent round had happened 1 year or 1.5 year back,
Mm-hmm.
then how do you adopt a back solve in that scenario?
So the prerequisite of using a backsolve valuation method is, one, there should be an arm's length transaction. If at all the transaction itself is not an arm's length, then there is no purpose of doing the backsolve, because the valuation that would be arrived won't be an fair value, because it has to be an arm's length. Second, it should be a recent round of transaction. And by recent, you cannot find any definition of a recent transaction. But as a market practice, I see anything in the range of 6 months to 8 months is considered as a recent transaction. Maximum till 1 year. Anything uh, previous to 1 year, I think it cannot be considered as a recent transaction. So that's the
So,
prerequisite of using
No,
backsolve.
Bhavik,
sorry, my
to just
question is
to,
little different. I'm saying
yes,
that we are approached by the client to
okay.
determine the valuation for the different class of shareholders
Hmm.
where there is no precedence of a recent round in a 1 year timeline.
Okay,
So
Bhavik, that
you have
becomes
before 1 year.
slightly tricky. Yeah, that becomes slightly tricky. I would go back to IPEV guidelines because that's where most of the times Backsolve finds an application. You can still start from the last transaction which may have happened and try and see if you need to adjust that value for any sort of market movement or facts and circumstances of the company. But in my experience, we have not adopted backsolve if there has not been a transaction in the last 12 months. Again, if the transaction has not occurred in the last 12 months, but you still have a precedent transaction, which may be older than 12 months, you may make adjustments to that, considering market changes or changes in the performance of the company or any other facts and circumstances, and use that as the first indicator to carry out backsolve. Otherwise,
So
we will not
in that
achieve the
case,
purpose for which we are doing this.
my argument is, can we not use a discounted cash flow method of the company and then allocate the value using these breakpoints?
Then see the only of course you can do that, you can definitely do that. The only difference here would be that you will not be there will be nothing to goal seek for. In that case, the 2.67 that we see here in this example becomes the input and everything else is an output. But again, you can still compare the $0.2 equivalent to the value implied by the last round and see whether it is making sense. Like, use the primary step of backsolve as a sanity check rather than the outcome. So you can still use it, but again, it can be challenged. It can definitely be challenged.
So what happens, Apeksha, that so if you are approached by a client and they are planning to raise a Series B round,
Right.
and when they say that Series B round, there is a lick pref which is there, and the value has to be not equivalent to the equity shares
Correct.
because of the liquidation preference. In that
Correct.
scenario, how will you approach it? And if the Series A round has happened 1.5 year back,
Hmm. So
so
tell me one
my
thing. In this case, you are pricing for the Series B shares.
yeah,
Okay, then I would go with the approach that you said, Bhavik. I would go with that,
okay.
but I will be very careful in determining the break-even points to consider all the rights and terms and conditions attached. And the DCF, I would do a cross check with any other method which may be adopted, like a multiples or a transaction multiple. But in this case, I think this is the best approach that you would take any which ways, because there is, I mean, like you said, there is no recent transaction and you're pricing for it right now.
So when you are pricing for it, then also you will take a post money, you will ideally take a pre-money valuation, right?
In that case, your per share value will not differ, right?
But will it
Uh,
not? But I think so, Bhavik. I just want the new round of funding will be a different preferred stock with different liquidation preference, right? It will not be the same as the existing preferred stocks which are there in the company, right? They will have some preference or over
No,
and
so
above
they
the
will
already
they will
issued,
have a from a waterfall perspective. Basically, Series B will have the first priority,
right?
and then Series A,
Right.
basically. But
Yeah.
what the client intends is that the equity share value has to be different from CCPS values. So
Okay.
in that kind of a scenario, if you use a backsolve, then ideally, my question is on that 267, which is a goal seek. Over here, I cannot have a goal seek.
It
And
has
that is
to
the
be
reason I
post
asked.
money value, Bhavik.
Post money. Post money.
Post
Post
money
money.
has to be post money. Yeah, yeah. Then only the allocation to B1 category, which you are now subscribing for, will fall in place, na?
So Bhavik, just to give things more in prospect, your ESOP 1 would get replaced with Series A, then you will have Series B here. And if you have Series B in your cap structure, which implies that there is already a cash flow that you're gonna receive in your business. So it already implies that the valuation that you will get is a post money valuation. Having said that, the only difference between this example and your example is with it will be the goal seek feature that we do, since we do not have the transaction of the Series B which is actual happening, but the client is looking for a, a indicative value at which he is supposed to do this transaction. You will not goal seek, but instead the business valuation from the DCA would act as an input, and accordingly you will value allocate to the common stock Series A and Series B.
So, Nikhil, why not a pre-money work over here in this scenario?
So in pre-money case, you won't have the asset class, right? The in
So
case of
it is like
pre-money,
Okay. No, I understood.
you're
Maybe,
trying to
yes.
solve
You're
for
correct. That,
ESOP 2. वो
yeah.
होएगा ही नहीं ना अगर प्री मनी
Yeah,
करेंगे
yeah,
तो.
understood, understood.
there
Right.
would be only two classes then.
Right. Right. Thank you. And one more question, if I can take up, and I hope I'm not budging in the time.
Sure.
So, so basically, how do you decide whether you should do a backstall or you should do a plain equity valuation and you divide basically? Is it only dependent on the cap structure, which will be your
So
decision-making factor?
So, Bhavik, more often than not, there is a pushback from all stakeholders, if I can say, to use BACKSOLVE. We as auditors have pushed back. We have been pushed back where we were third-party valuers and have not adopted BACKSOLVE. So more and more the acceptance of this method is going up, and more so suited for situations which have extremely complicated cap structures.
Correct. So that's the
And like
one
I
of
said,
the
that if the fully diluted stake works in certain situations, one can still go for. So I will give you an example. I was working on an infrastructure transaction recently where once the series F, I think, or series G funding had come in, all the preference shares stand pari passu. There is no preference or ranking in terms of liquidation or any promised returns to anyone. In that case, we did go with a fully diluted and we did not do a BACKSOLVE, because in that case there is no liquidity preference to anyone over the other. There is no rank of payment, like last in first out, nothing like that. The dividend was minuscule, and the conversion can happen at any point in time. So in
But
that case, it made
in
sense to go with the fully diluted
okay,
approach.
and in your scenario, if there was a liquidation preference of 1x
Huh.
in terms of the waterfall, then would your answer differ and you would
My
have
answer would
chosen
still be the
BACKSOLVE?
same. My answer would still be the same because it's all pari passu. So अगर
It's
company
all
का
pari
value
passu, yes.
it's all pari passu. So अगर company का value 1,000 है and invested amount is 2,000, then 50% is what
Everybody
is
gets
applied to
50%, right?
everyone.
correct.
Okay, okay.
So it depends
Thank
on
you.
the complexity of your cap structure.
Thank you.
So this was a simple example, a theoretical example. So just to summarize, what we did is we estimated, means we took a random value of the company and we determined the threshold for each of the asset classes based on the capital structure analysis. Based on the capital structure analysis, we arrived at each break-even point during waterfall analysis. The break-even point is nothing but the point at which it is profitable for the investor to convert their securities into a common stock. After that, using that break-even point, you arrived at a call value and the incremental call option value using a Black-Scholes option pricing model. And the last step, after that, you arrive at a percentage allocation for each of the asset classes. And based on that, you arrive at the value allocated for each of the asset classes. And the last step being the goal seek, wherein based on the latest transaction, you backsolve to estimate it, the original equity value of the company using the latest transaction price, which happened at the arm's length. Now, this was a simple example that we have used. Now we will move on to the actual case studies that we have come across during our exercise. In this, there are two case studies that we will touch upon. First, we will look at case study 1. Before going actually into the case study, let's have a quick background. It's a company had a company funding in a series B2 round, which included A and B. There were around 60,000 number of preference shares, price at around 300 per unit USD. The total amount being $18 million. This was the latest transaction which had happened. All the preference shares are redeemable at the issue price plus 5% compound interest by Feb 23. This was their liquidation date by which the management estimated. The liquidation preference was all the preference shares, okay, are to be paid at their original issue price per share plus the 5%, and they have a same liquidation preference who shall have a priority over the ordinary shares. So series A, B1, B2, B2 may be A and B, all the preferential holder had the same liquidation preference right, which have the priority over the ordinary shares. And our purpose was to find the equity valuation of the company as of March 2020. Now for this, we will look at the Excel file and I will have to exit the screen.
So while Nikhil opens the Excel file, I will request everyone to pause us if there's any doubt, because the Excel understanding is most important of how the equations really work. So feel free to stop us in between and we will take up any explanation if required again.
Can you see my Excel file?
No, Nikhil, not yet.
Can I ask a question, unrelated question in bit, or should I take it at the end?
Can I request for us to cover the case study, and then before we take up the next
Sure,
one, we can go to your question.
sure. Thank you. Yeah.
Okay. Okay. So the first step is to analyze the cap structure. So this is the first step in our backsolve method. As per the background, the cells which are highlighted, okay, are the inputs to our cap structure, which includes the different asset classes before our latest funding round. Our latest funding round was series B2, A and B. Can you see my Excel file, right?
Yes.
Okay. So the total number around 60,000 series B2 preference shares issued in the latest round at the price of $300 per unit. The conversion ratio for them and for all other preference shares was 1:1. All the preference shares uh, had the same liquidation preference. Okay. The rank is 2 because they also have a debt, a non-convertible debt, which has the higher priority than the preference share. Hence, the debt would cover first, and then all the preference shares would participate in the liquidation preference. Since they are all the preference shares are converted at 1:1 ratio, you find the percentage ownership on the fully diluted basis. And they also have a dilutive instruments like ESOP, which is around 38,300 at the negligible price. So it's 0.01. So it's as next to free ESOPs to the employees. Okay. And the preference shares also had dividend, the dividend at 5% per annum, starting from their issue date. And as per the management representation, the liquidation date was around Feb 23. So each of the preference shareholder were entitled to a 5% per annum compound annual interest rate starting from their issue date. Hence, you compute the liquidation amount for each of the asset classes. Any questions on the capital structure? Okay. So before proceeding to our next valuation, there are few of the assumptions and I would say a representation that we received from the client. The valuation date we assume at 31st March 2020. The liquidation date, the tentative date for an possible liquidity event was given as 3 years from the valuation date. We arrive at a historical volatility of around 53% using the comparable companies. The dividend yield was assumed as 0 and the risk-free rate as per market was 0.3%. Using this data, we will now analyze the waterfall analysis. Starting with enterprise 0, nothing, no one gets nothing. 0. And the first preference would be to the debt. The debt would get their amount, which is the amount of debt is equal to 10 million USD. They would get their amount starting from 0 till their endpoint of 10 million. So first preference of participating would be the debt holders. After that, all the preference shares would participate at the same time in the liquidation preference, since they have a same liquidation preference right. And hence their participation would start only after debt has already been paid off. So their participation would start after 10 million. Followed by the liquidation preference, the common stock and the ESOP would participate. The common stock and ESOPs are clubbed together because the ESOP price is next to 0. Hence, it's clubbed along with the equity shares. So the number of shares that would participate is equal to the quantity of ESOPs, 38,300, plus the ordinary number of common stock, which is 128,200. So if you sum this, you will get 16650. Yeah. This is the number of participating shares. They will participate only once all the preference shares, the previous liquidity event has met their liquidation preference amount, which is nothing but your debt amount plus the liquidation preference for all the preference shares, which is N12, which is the summation of all their liquidation preference amount, which includes their dividend amount as well. So
this is important to note actually that in the liquidation rights, if there are any returns attached to the initial subscription amount, that would also be considered to determine the break even, because that is the that's the minimum return which the investor expects to earn. If that is not achieved, they are unlikely to exercise the option to convert. So this is an important aspect which should be ideally considered every time you're determining the break even point.
So this determines your entry point for the common stock. Now the next event, when the conversion of the first preference shares, the seed preference share would participate. They would participate only once all the common stock has met with their uh, uh, amount. So what this amount would be, starting with the number of participating shares. The number of participating shares is nothing but the previous common stock and ESOP plus the number of quantity of the seed preference shares. The seed preference shares is nothing but your number of shares as per your cap structure. And since all of them has a 1-to-1 ratio conversion, this number of shares would convert into equivalent amount of common stock. Hence the total number participating shares is summation of the previous common plus the series seed preference share. Then you will multiply this with the original issue price, the original issue price for the preference seed preference shares, because at this price they are tend to exercise this. So this is total number of participating shares multiplied by the issue price, and then using this computation, you will arrive at the break-even point. Now, what is this break-even point for the series seed preference share conversion? It is the summation of the earlier break-even point plus the number of participating shares, the equity shares that would participate uh, in terms of monetary terms. And from that, you will minus the series seed preference shares which have already converted into the common stock. And hence you arrive at the break-even point. Any question at this point?
This example is slightly more complicated than the example that we did before. So please feel free to ask us questions. Nikhil, in the meantime, can you resize column I?
So again, to explain this, series seed preference share would start participating, or it would convert into the equity only once the common stock has already met their amount, and that break-even point is equal to the previous break-even point plus the total number of outstanding equity that there are, and from that
At
you
that
will
stage. At that
yeah,
stage, actually.
at that stage, and from that you will subtract the number of preference shares, the seed preference shares, which have converted into the equity. So they are no longer, they have given up their liquidation preference as a preferred stock, and they have participated by converting into the equity, and hence you subtract it. Moving on, the same exercise will get repeat for each of these series, for the conversion of each of the series. Now moving on to the series A, the next series. The number of participating shares would be previous plus the total quantity of series A. You arrive at the monetary value, which is the equity, the total number of participating shares multiplied by the issue price of that series A. And from there, you will minus. So now the next point. How you will compute the break even? The break even point is, you use this or this, it doesn't matter. Okay. It's starting from the break even point for the all the equity and common stock. To that, you will add all the participating shares, and from that you will minus this previous seed preference shares and the series A preference shares, because they have converted into equity, and hence they will give up their liquidation preference in terms of preferred stock, and then they have participated by converting into the equity. Again, for the next.
So what is the calculation of that liquidation amount in column L?
It's your original issue price plus the 5% dividend for each of the series.
Yeah,
Ravi,
got
in this
got
particular
it.
case, there is a guaranteed return also. So the return amount needs to be considered when you are determining the break-even point, and because that's the minimum you would have got over and above your invested amount, right? So that is
Had there
important
been
to consider.
Had there been no dividend, you might have taken the liquidation amount as this, which is the quantity multiplied by the original issue price.
Got it.
But they are
Yes,
subject to
thank you.
5%. So next round is series 2. Similarly, for the same computation, the earlier participating shares plus the number of series A shares, you arrive at the total number of participating shares multiplied by the issue price, and from the common stock to the common stock, you will add the number of participating shares, and you will subtract the liquidation amount for all the previous series which have converted into the equity, and so on and so forth. You will do for the next series as well. So this, by this you have arrived at the break-even point for each of the asset classes. Your asset classes being debt, preference shares, the common stock, and the convert the each of the, sorry, not asset class, so each of the events. starting with the debt, then participation of all the preference shares, the common stock, and then the conversion of each of the preference shares. The next third step being the option valuation. Option 1 to 8, which represents the step, the event 1 to 8. You start with a random number. Let me change, since I have already worked this example, that's why it matches. Let me just change this number to something else. Let's say I take it 110. Okay. 11 million. Okay, it's a random number. Okay, so we are just playing with a random number now. 11 million. So assuming the underlying business valuation is random number 11 million, the remaining tenure of around 3 years from the management and relevant market data, you will compute the call option value for each of the options, the events. First being the 0, then there is the debt, then series, then all the liquidation preference, then common stock, seed, 1A, series, till the end, series B to A and B. Accordingly, you will compute the incremental call options value. Then, like we did earlier, we will compute the percentage allocation for each of the participation. So for the first event being the debt would participate fully and none other asset class would participate along with that. After that, all the preference shares would participate at the same time. And all the preference shares have participated at the same time here. In that state, the common and ESOP and debt will not participate. Then the common stock and the ESOPs, the common stock and the ESOPs have participated. And after that, the conversion of each of the preference shares. Based on this, you will compute the percentage allocation like we did for our example earlier. Show you total. So you will compute the total amount here. And you will compute the percentage allocation for each of the cells. Using this percentage allocation, now you will move on to the next implied valuation. So this series, this allocation, what you see is the amount that we have computed here. This event are the event that we identified in our waterfall analysis. These are the strike price that we identified in our waterfall analysis, the call option value, the incremental call option value, and the percentage allocation for each of the asset classes. Based on that, one more thing. The purpose of this exercise is to compute the equity valuation. So hence, you will keep the debt out of your computation. Okay, and hence, if you look at this valuation, I have purposefully not included the debt in my computation. So for each of the NCs, for that also I haven't computed anything. So
That is primarily because debt is not part of equity which needs to be allocated. So if there are any instruments which are debt in nature, ideally from the overall enterprise value, one should take out that value and then do the analysis on the remaining amount, which can be ascribed to equity and equity equivalent instruments. That is important, and a lot of times this gets missed out. This is a common error that we see a lot of valuers making.
These are the number of preference shares, equity, and the ESOPs. And then you have arrived at the per unit valuation. Only to ease up the display, since this is a horizontal display, I have displayed this in a vertical format, wherein you have a class, you have a quantity, you have the value allocation, and then you have a per unit value. Now, our purpose is, we know that the latest transaction happened at a price of $300 per unit. So our purpose is to goal seek this per unit value by changing the equity valuation. So what I've done is I've just linked this cell.
Nikhil, I
What?
think your screen is frozen. Which tab? We can see tab 3 ESOP. Where are you?
No, I'm at BACKSOLVE output tab.
No, no. I think the screen is frozen.
Okay, just let me share
Apeksha,
it
I
We
think
again.
so.
we can
We
see
can
it.
see
Yeah.
it. We can see it. Yeah.
Okay, okay. Maybe at my end then.
Okay. So what I will do is data, what if analysis, goal seek. I will goal seek the result that I have got such that it's equal to the latest transaction value, which is 300, by changing the random number equity valuation that I have used. And hence I arrived at a valuation of 121 million. So using this, if you see, this number is used as an input in our Black-Scholes model, and hence this value gets allocated across the cell, and hence you arrive at a $300 per unit for your series B2.
So, Nikhil, I have just one question here.
Hmm.
We know that at 300 rupees is the goal seek. I wish. Now, only thing is, I was just thinking whether we need to have the debt instrument as one of the threshold limit, or we can start ignoring the debt and then arrive at the equity value, because what we are arriving here is more like an enterprise value, I understand.
No.
Right now we have purposefully removed this debt. So right
Yeah,
now
here
what you
it's
see,
okay. But when you did
yes,
the goal seek, what number is going as an input into your option model is the enterprise value, right?
Yeah. No, no.
yes,
It's actually the equity value, na, Nikhil?
Yeah,
We have.
121 is enterprise value, right?
yeah. So how this has arrived is the input is going as an enterprise value, but your
Right.
allocation is happening at the equity value.
Equity
Yeah,
level.
understood, understood.
Yeah,
No, so what my question is that if you can go to that option model,
yeah.
I think so, BSOP, yeah. The way we have started at option, 0, and then the next is 10 million. Would it be okay to start with 0 and straight away go to 83 million,
Correct,
which
correct,
will
correct,
arrive
correct.
at the
So
equity value?
if yes, so if you delete this
Hmm.
option 2, then your accordingly you will arrive at your equity value.
Yeah, which could be similar 111 million or something which you have worked out.
Yes, correct. But since I have included that in my waterfall analysis, hence I'm using this as an input because
Understood.
it adds one more step in my break-even point.
Understood.
But the purpose is to find the equity valuation. Hence, you
But the answer will be
purposefully.
same, right, Nikhil? Whether I do a 0, 10 million and then do it, or from 0 to 83 million when I do it, the answer should ideally be the same, right?
That's a good question. I haven't worked out, but ideally it should be same.
Okay.
Sorry, I missed the last maybe 30 seconds, 1 minute, and I couldn't see the screen before that. So, Bhakti, if I can attempt to answer your question, can you
So,
repeat it for the benefit?
yeah, so what I was trying to say is in the option model, when Nikhil has worked out, he has put 0
Hmm.
million to 10 million as the first threshold because there is a debt. And then from 10 onwards, there are all equity participants which are involved.
Right.
Now,
Right.
I was just checking with him if I see 10 million is something which is like a fixed number. They don't have any
Right.
participative rights or anything. So
Right.
can I start to say that I start with 0 to 83 million as my first threshold? So what happens when I do this goal seek? I'll arrive at an equity value rather than an enterprise value.
But Bhakti, in that case, what will happen is, no, because see, the equity holder will start getting value only from 10 million onwards.
Which I'm saying is the equity value. So I'm saying equity value is 0. Right now we are saying enterprise value is 0 to 10 million. When the enterprise
Correct.
value exceeds, I'm saying if the equity value is 0, which means after reducing the debt, that's where I start with it. So
Okay.
when I do the goal seek, I come to back
Hmm.
to equity value rather than an enterprise value.
Okay, I
And then I
understand what you're
asked,
saying.
yeah, and then I asked Nikhil whether my answer will remain the same if I do that. So he was saying that it should ideally remain the same. He has not worked it out, but yeah, we can always check that whether the answer will remain same or not.
And that is for us to check also. Honestly, even I have not attempted it like that. I'm not very adventurous
So I was
in
reading this
testing the.
AICPA some
Mhm,
extract somewhere. So
mhm,
the practice aid or whatever that
mhm,
is
mhm,
there for this
mhm.
convertible, and I think so somewhere they mentioned it's better to exclude debt
That.
in the
Correct.
analysis and start
Correct.
with an equity value analysis.
So that is correct. That is right. But I have also seen practitioners who have relatively more experience to say that if you ignore debt, some debt may have convertible elements also. So it's always better to start from enterprise. I think it's the way you look at it and what
Yeah,
suits each circumstance.
understood. Understood.
So based on your decision, it's the break-even point that you will decide. If at all you are looking at the enterprise value, you will include that
Yeah,
in your
yeah.
waterfall analysis.
But we should definitely test it, Nikhil. This is
Yes, yes,
something
sure.
which we've not even thought about really.
Sure, we'll do that. So this is our first case study. This concludes our first case study. Uh, any more questions on this?
Nikhil, I got one question in the chat from somebody who asked that for a June 2022 reporting, uh,
Mhm.
uh, uh, no, for the reporting date of 31st March 2022, if you're doing the valuation in June 2022,
Mhm.
and a transaction has taken place both in November 21 and in April 2022, what should be used as the most recent round of funding? So various dates. First round of funding happened in November 21. Second round of funding happened in April 2022. Reporting and valuation date is March 2022, and the engagement is being carried out in June 2022. These are the timelines. Reporting and valuation happens in March 2022. This is the question which we got. What will be considered as the most recent round of funding? This is a slightly tricky one. Uh, it depends upon what kind of rights and preferences your client has in the company which has issued the shares. Because if there is a board representation or if there is a significant stake on a fully diluted basis, or there are any other rights which enable the holder of the security to have access to the information that such a transaction is being evaluated in April 2022, and one can establish with confidence that the price discovery of the subsequent round or the most recent round has been concluded by 31st March 2022, then it is prudent to consider the April 2022 round as the PORI. But see, administrative factors, condition precedent not being fulfilled, and hence consequently the transaction may have spilled over to April. But if the price discovery was done by March and one can establish that, in that instance, considering the April 22 round will be most prudent. But if, say, if you're in May and the reporting was in March and there was no in no way can one establish that the holder of the instrument had access to information about a subsequent round, how much ever close it may be to the reporting date. In that instance, it makes sense to ignore it and consider the November 21 round as the recent round. I'll give you an example. We were this is a startup that we were valuing. It's a unicorn today, and this entity had a transaction declared on 10th first week of January, and our reporting date was 31st December of the previous year. In that instance, this particular company had a board representation. They had a, I mean, and their vote would, I mean, they had also a board seat, right to vote and all those kind of rights attached. So they had documentary evidence to say that the price discovery had already taken place. Binding agreements were signed in the first week of January, primarily because of the holiday period in the overseas market. And in that instance, we had taken the round of funding as the most recent round. But the facts and circumstances is if they do not support the discovery of a price by the reporting date, it's prudent to ignore it.
Yeah, thanks for explanation. Just a little bit more into it on the same. As you rightly said, the price discovery has been happened. But in this case of Pori Bexol method, and when we arrive at allocate the value to each and every categories of instruments, and the ESOP values has also been arrived. And as on the reporting date, if we have to account for the ESOPs based on the share-based payments, IFRS 2 and all. So if we are considering that the later on funding which has been taken place, but the the accounting treatment has to be done on the same basis, so it will having a huge large impact on the financial statements where there is no money as such in the reserves available, or there is a very high hit on the same basically. So how do we handle that basically? Of course, this is a prudent concept is there, but yeah, the standard also say that there should be a known and knowable event as
The
of the reporting
ICT
date.
guidelines also talk about the known or knowable event.
Yeah.
So, if in your instance you are able to establish that the price discovery was already done, and your client or in this particular case, the company who's issued such ESOPs was aware of this price discovery, then it becomes very difficult to ignore it. I mean, if you have evidence which points towards this, irrespective of the client expectations, I would find it difficult to ignore such a fact. I mean, I appreciate the consequence of a large expense in the financial statements, but to say that a transaction occurred in April 2022, where all the facts were known or knowable at that stage to the issuer, then it becomes extremely difficult to ignore it, right?
Yeah, Apeksha, yeah, just to add on to this, I did work on one of the assignments which had a similar issue wherein the October they required the the equity valuation for the ESOP provisioning, and for that they required the ESOP the equity valuation to compute the ESOP valuations, and the latest funding series one held in around uh, a tentative date, like say suppose in September 22. Okay. However, because of the administrative issues, the actual cash that was supposed to get infused in the company was approx December 22. So based on this, there was a requirement of doing the valuation as of September, and hence we face the same question whether the cash which is supposed to get subsequent to the grant date, whether you should take this cash into consideration as of the grant date or no. So there was a series of discussion with the client, the management, the auditors, and subsequently it was finalized that since the price discovery and knowledge was already available, the information was already available as of the grant date, the equity valuation must reflect this future infusion of cash, and hence the valuation that was arrived include this infusion as well.
In fact, Ravi, I have also seen an instance where the price of a recent investment was considered with a marginal discount to factor in uncertainties between price discovery and final closure or signing of binding deals. So we have also adopted in some cases adjusted PORI, where we adjust the price for a small margin of uncertainty relating to timing of the time difference between the reporting date and the actual date of signature of the agreement.
So like differential delom, you mean to say?
Sort of, yes. It's a subjective assessment, but we have definitely done that as well. So it's slightly circumstantial, I will say. No hard and fast. But again, the guiding principle is known or knowable as at the measurement date.
Perfect. Thank you.
So moving on to the
There
next.
was Nikhil, just one thing. There was a question from somebody, and I said that we'll park it aside before we start the next case study. So if you'd want to take it up.
Yeah, sure. Can you just repeat the question?
No, that person is to say the question. I don't know the name.
It was me only. I think it's sorted.
Oh,
Apeksha. It was me only at that time.
Okay, sure. We'll move ahead.
Okay, so this is the second case study that we will look into. You can see my screen, right? The PPT slide.
Oh,
No. Hmm.
Nikhil,
Now.
focus on the differences between case 1 and case 2. That will be helpful.
Yeah. So first, a quick background. The case study 2 involves Series C plus preference share invested at an amount of $250 per unit in April 2020. Here, the liquidation preference is different for each of the preference shares, wherein in the previous example, all the preference shares had the same liquidation preference, wherein in second case study, the latest preference share had the highest liquidation preference, followed by the earlier one. And at the end, the last liquidation is with the ordinary shares. This is the one of the difference between case study 1 and 2. The second case study difference between 1 and 2 is earlier they had the dividend of around 5% per annum. In this case, there is no dividend as such. So it's the original issue price that they have invested, which is equal to their liquidation preference that they are entitled to. The transaction happened in April 22, and you are supposed to find the value of the company as of August 22. Looking at the cap structure. And one more important thing in this second case study is the conversion of liquidation. All the preference shares would happen at the same time, irrespective, like in earlier example, where the conversion of each of the preference shares were happening based on their original issue price. Contractually, in the second case study, all the preference shares would get converted into ordinary shares at the same time. Using this as our background, I'm sharing the Excel file now. Can you see the capital structure?
Yes, Nikhil.
Yes. So same like earlier example, the colored cell are the standard inputs, the number of shares of each A1, A2, B, C plus. C plus being the latest round of capital infusion at 250 price. All of them converted in a ratio of 1:1. The only difference being all of them would, sorry, what happened? All of them would get converted at the same time once all the liquidation preferences met.
the earlier case also the conversion was at the same time, right?
No, the conversion was based on their original preferences. If you want, I can just open that.
So you mean the conversion price or the time?
The issue, the timing of conversion were different for in the earlier case. In this case, the timing of conversion is same.
But if the timing of conversion was different, have we captured that separately? We assume the same time to liquidity, right?
No. Let me just open that.
Nikhil, I think it will be better answered when you attempt the break-even point, because over there you've clubbed it, right?
Yes.
So go ahead and explain this when you reach that level.
Sure. The liquidation rank is the liquidation preference. The series C plus has the highest liquidation preference, followed by the other series. They have a dilutive instruments which are ESOPs and warrant at their respective strike prices. The basic assumptions of our input is valuation required as of August 2020, 3 years as a date of liquidation, and volatility of 30%, risk-free rate of 0.81%. Now the waterfall analysis. The event. Now, 0, no one gets nothing. Then the liquidation preference. The series C plus gets the first liquidation preference. Unlike in earlier case where we have clubbed all the preference, all these preference shares and arrived at a single preference liquidity preference. In this case, we have a different liquidation preference. So this for the first series C plus, they will start participating at 0, and they till all their liquidation preferences met. This amount is equal to their original investment amount, which is their total investment multiplied by the quantity, 13.5 million. Post that, series C will participate. I mean, they will look for their liquidation preference. Their starting point would start once the C plus has met all their liquidation preference, and would end at their amount of liquidation preference, which is N6, capitalization N6, this, which is nothing but your original issue price multiplied by the quantity. Similarly, for the series B, series A2, A1, and accordingly you will compute till all the liquidation preference has met their liquidation amount, which is nothing but their original issue price multiplied by the quantity. So if you look here, 69,258, it's nothing but summation of all your liquidation preference amount, after which the common would participate. So the common stock will participate after all the liquidation amount has met. And note here, all the preference shares would get convert at the same time. So the common stock plus summation of all this number of shares would get converted at the same times. Ordinary shares plus the earlier one, and their break-even point would be once all the last liquidation preference has met. So it's this plus capital structure C and 3 and 3. So once the common start participating after this amount, the ESOP would participate. And how this ESOP would participate is the total number of shares which participate plus the number of ESOPs, which is 152. So if you add this plus this, same number, which is nothing now, this the number of participating shares multiplied by the price of the ESOP. And since this is the price which is supposed to be subtracted, like we have done in our example, we will, from this total number, we will subtract the amount which is received by the company, which is nothing but here the quantity of ESOP multiplied by the strike price. So your break-even point would be nothing but your previous break-even point plus the total number of outstanding shares multiplied by price minus the price which the company has received based on the exercise of the ESOP. So this acts as your break-even point for the ESOP. After this, the warrant would participate, which is nothing but your previous number of outstanding shares plus the warrant. The total number of shares, which is shares multiplied by the price, is 201. On exercise, they will receive around 4 lakh rupees. So your strike price would be nothing but your liquidation, the total liquidation preference amount plus the conversion, plus the participating shares minus the ESOP, the value that company would receive on exercise of the warrant, which acts as your exercise price. Based on this break-even analysis, you will move to the Black-Scholes computation, wherein event 1 to 8 represents each of the options 1 to 8, starting with 0, and based on each of the break-even points that we have arrived, we will compute the call option value, and accordingly, you will compute the incremental call option. Then you will move on to finding the percentage allocation for each of the asset classes, which is starting all the preferred stock, the common, these are the events and these are the asset classes, which is the different series of preference shares, the ordinary shares, the ESOPs and warrants, and this being the event that we identified in waterfall analysis. The first preference being to the C plus, then only C, only B, A, A1, and after that, common and the preference shares would participate in the conversion at the same time. Hence, all of them participating at the same time. After
Nikhil,
that,
just take a pause here. Just take a pause. Nikhil, Bhakti, to answer your question, you will see that in row 30, once the liquidation amount has been recovered for all the classes, and it's a question of conversion at the next break-even point, all of these have come into the equity pool at the same time, which was not happening in the previous one. In the previous one, as and when the threshold was being reached, they were converting into equity, and hence we were minusing the the liquidation preference which they may be getting.
Yeah.
Over here, everything is pulled together, and the conversion element to equity is happening together in row 30.
So basically, that will be defined in the agreement, right?
Yes.
That
yes,
once the threshold limit is achieved, all preference shares will be converted at the same time and will not have
Same.
different thresholds for conversion.
Yes,
It will
absolutely.
be guided by the terms.
Yep.
So accordingly, you will compute the percentage allocation for each of the asset classes, which is nothing the percentage computation for each of the cells. Using this percentage allocation, we'll find the value allocation for each of the asset classes, starting with the event identified in our waterfall analysis, the break-even point that we identified for each of the event, which is nothing but the point at which the investor would convert their securities such that uh, they are in a profitable position. Corresponding call options and their incremental call option value. Computation of the percentage allocation that we have looked earlier, it's nothing but the same I've populated here. And again, the sum product for each of the asset classes. The number of shares as per the cap structure, and then arriving at the per unit value. For ease of display, I have displayed it in a vertical format, each representing a different series of preference shares, the quantity, the value allocated, and the per unit. As per the latest transaction, since this I have already worked out this exercise, the per unit value, the latest transaction that happened was $250 per unit. So it's already goal seek, and this is based on the valuation of 48 million. Let's increase the accuracy of this. Goal sake, let us equal to 250 by changing the equity valuation. Okay. So likewise, we have arrived at the equity valuation of the company such that based on the latest transaction, the transaction price of $250 per unit for Series C plus, and looking at the economical the relations between the asset classes and their liquidation preference, their conversion terms, the business valuation, the equity valuation that we have arrived is around 47 million.
I think with this we come to an end of our presentation. So now, question answers.
So
Or
I have
anything on this.
I have primarily 2-3 questions. One is sometimes the companies have say 3-4 securities like Series A, Series B, Series C in addition to your equity shares. Now, generally, the company are reluctant to share the shareholders agreement, which outlines the liquidation preference.
Right.
So generally, we end up asking to share the brief terms and conditions. And most of the time, the companies do not end up giving the liquidation preference clause. They just end up giving the main terms and conditions to say that this carries a coupon rate of so and so, the conversion option or the tenure of the instrument is so and so, and that you can convert it at so and so price, or it's 1:1 or whatever. Now, in such cases, for example, it's a fixed conversion. To say it's convertible either 1:1 or there's a fixed conversion price which is mentioned. Now, unless as a valuer you do not have access to the liquidation preference, we may end up just doing a dilutive impact of the convertible security which is provided, and you just arrive at a value per equity share and you apply to the CCPS and you say this is the value. Now, whether you think in your experience we should insist to the company that you also give us the liquidation preference, what is there, and accordingly then use a BACKSOLVE method to arrive at the value of the different securities, or you just then go ahead with whatever was provided and carry out the valuation based on a dilutive number of equity shares and just calculate it.
Bhakti, very circumstantial. And in case of most clients, until unless it's the issuing entity, where you're doing an ESOP for financial reporting, that's a separate case because client itself is the target. But if you're doing this for a private equity client or for a venture capitalist, most of the times the stake may be small, and full information about the subsequent transaction or the rights preferences may not be shared. Now, in those situations, it's a judgmental call which the valuer has to take, really. I mean, see, if the so you can ask for management representation on key terms which will influence your decision making. If they're giving representation, then I would believe the client would go with facts and not put incorrect things. So certain things which we definitely ask for, if we do not have access to the overall agreement, we will ask for the the participation ranking, we will ask for liquidation value, and if it's 1x 2x, we will ask for conversion ratio. And we can ask them to, even if they're not willing to extract it, at least to put it on email or something. But it's important to ask that information. And beyond that, if the client is not willing to share, then we take a valuer's judgment and we go ahead with the most appropriate method.
Understood. So if the information is provided in terms of various liquidation preference or various rights, ideally it is better to do the BACKSOLVE and then calculate
Yes.
this.
Yes.
Second was in terms of the various instrument conversion period or the redemption period which is provided. Now here what we are looked at time to liquidity, that the company expects to go for an IPO after 3 years or 5 years, whatever, and we capture it. Now that instrument, say there are 4 instruments and each instrument has a separate tenure for either conversion or redemption. So any optionally convertible instrument, for example. Some optionally convertible instrument, we have a time period to say that, okay, up till 2 years, either you convert it or we'll redeem at the end of 2 years. Some instrument could be that you have 2 years to opt for conversion or opt for redemption, post that it will be compulsorily converted. How those elements can be captured in this method? Because ideally, if you look at it, those are different terms by itself.
Okay. Have you encountered such a situation?
So I have not encountered, because this is basically when you do individual instrument valuations, when it comes to, you generally see these terms and conditions, right? And chances are there that could be there for various instruments. The third case will be that you have, say, common stock which is with voting rights, but the convertible instrument you may convert into equity shares without voting rights. So how do you capture all this? Because this generally you will find it in a startup where you will have,
Right.
voting, non-voting rights, and then how do you capture into a backsolve method?
So, Bhakti, very difficult to answer. Honestly, I have not seen such a complex. Well, of course, I've seen till series G or F maybe with all different kinds of rights and privileges. But having a combination of different instruments, I have not seen. I have not seen such a complicated cap structure in the Indian context.
Okay.
But I had earlier, maybe like couple of years ago, I had worked on an instance where there was a convertible loan. So in that case, the conversion element of the loan was considered in the overall table, where they said that the loan will eventually convert because there was also an interest rate analysis which was carried out, considering data from Bloomberg, where the valuer looked at how the interest rate is expected to grow, what is the return coming from this debt, and hence whether it makes sense to convert or to hold on and get a redemption after 2 years. So all of these factors were considered, and he rationalized out that why that loan should be considered as equity and not strictly go with the redemption scenario. This is the most complicated in terms of different categories of instruments which I may have seen. So again, I would think it's more circumstantial, and whatever decision we take has to be backed by a rational logic which is explained in our calculations.
And the third one was in respect of warrants and ESOPs in the backsolve method. One is, say, if I had to do a ESOP valuation on a standalone basis, say we did that BSM method and you arrived at the option value. Whether that valuation would reconcile with the value which is arrived as per backsolve method, or it could be different. Similarly for warrants.
It may be different because the simple BSM will not capture all these nuances which we speak of, so it could be different.
So then,
So
sorry, yeah.
just to add on to the Apeksha's comment on this, uh, it would be different. You won't find 100% match between the ESOP
Value.
valuation that you arrive at the backsolve and you doing the option pricing model independently. But having said that, the difference cannot be a drastic difference. If there is a drastic difference, uh, it's a more of an indicator that somehow you are missing something in your backsolve, whether be it the understanding of the capital structure or the waterfall analysis, break-even point computation, so on and so forth. But having said that, a marginal difference, it's okay, but they would never 100% match with each other.
But Nikhil, then again, in this sort of a situation, one may not adopt a BSM in the first place because the purpose of carrying out backsolve is to arrive at the value of the equity, which one is not able to do it using a simple PORI. Had the PORI
Yes.
option been available, one would have simply adopted the BSM and been done with it.
Yeah. So how what markets, what I've seen in the market practices, using backsolve method, the purpose is to only arrive at an ordinary equity share value. Once that is arrived, they use this ordinary equity share value, and then they use this output as an input in their Black-Scholes model.
Absolutely.
And then based on the different vesting schedule of the ESOP, because in backsolve there is nothing captured with
Right.
respect to the vesting
That's
schedules
what.
of the ESOPs, right?
Yeah, right,
So in
right.
order to, so the correct approach to value an ESOP would be to take the output of the backsolve
Come here.
method and then use as an input in your normal Black-Scholes model, wherein which incorporates the expected life of the ESOPs, the vesting schedules, different exercise price, and then arrive at the valuation.
I think so. Same would apply for warrants also, because warrants
Yes.
also, because it will generally have a tenure of 18 months. And obviously, there will be certain adjustment in terms of upfront amount which is being paid, which is more like a sunk cost at the end of the day if the warrant is not exercised.
Yeah.
But there is no way in a backsolve method to distinguish between voting and non-voting, right? Here we are treating everyone at par. There is no separate adjustment which we can do for voting and non-voting.
No, I have not come across. Nikhil, what about you?
Yeah, so just if you remember, I was also looking for some article related to
Right,
voting rights, right?
right.
So, Bhakti, to answer your question, you won't find anything with respect to the voting rights.
Hmm. And this method may not be able to address that complication.
Yeah. Okay.
Voting rights are more of a subjective call, which is outside the purview of the backsolve.
Here's where the art comes in, no?
Yeah.
Rightly said, valuation is an art and not a science.
Any other questions?
Nikhil and Apeksha, Avik here again.
Yes,
Hi,
So
Bhavik.
just extending my previous example, and this is little bit of a hypothetical, one, not come across anything practically. But let's say there are Series A, Series B, and now there is a down round which is happening of an equity share, which is the primary round.
Hmm.
And because of that, there is an anti-dilution right which is hitting in. So Series B gets converted to equity.
Hmm.
And let's say you are doing the valuation now for determining a secondary transfer for Series A shares.
sorry, I lost your. Can you just
Sorry.
repeat again? Yeah.
Yeah, Nikhil. So I'll just try and repeat this. There is equity, Series A, Series B.
Hmm.
Now there is a down round which is happening, primary infusion in the entity of
Hmm.
equity shares.
Hmm.
So Series B's anti-dilution rights are getting impacted and it gets converted.
Hmm.
So technically at stage 1, equity shares are issued at a down round. Series B shares are getting converted at the same price to
Hmm.
equity shares.
Hmm.
So post stage 1, there will be equity and Series A, which does not have any anti-dilutive rights.
Hmm.
And now in Series A, if there is a secondary transfer happening, then how should one attempt a valuation? Will you take that down round or the down round value as the PORI and then attempt a back solve?
So,
Hope it is clear, Nikhil.
Bhavik, one clarification. When you say that the anti-dilution right kicks in that case, what do you anticipate to happen?
So
Um,
Series B opt for conversion to equity shares.
so their fully diluted stake remains the same, you're saying?
Yeah, so technically they have a conversion right to
Hmm.
equity.
Hmm.
So if they don't convert, they are falling below the threshold. So they convert at a down round value.
Correct, but in that case, the stake which they enjoyed in the company on a fully diluted basis pre this down round and post the down round remains the same, right? So in that case,
Technically,
and I'm also
yes.
thinking aloud. I mean, I'm also thinking aloud here. In that case, will the break point not be worked out in such a way that in the liquidation scenario, he's still eligible for whatever he's spent? And okay, I understand your question. Hmm.
No, but equity round, so just
Hmm.
to put a number perspective, if the round with Series B happened at 100 and
Hmm.
equity round is happening at 80,
Hmm.
so should you take 80 as the value, which is the PORI, or the 100?
I would still think 80, but how do you factor in the anti-dilution right as something to be delivered? I am
So
not in
technically,
two minds about how one should consider the latest round. If the see, and this is the case for most of our startups that we are seeing, right? There is a post listing, there is a huge value value breakdown, isn't it? So
Breakdown.
from that perspective, for reporting purposes, the whatever may be the anti-dilution rights and all of that, the marked down market value is still being used for reporting purposes, and even for transacting for that fact. So an equity markdown I would still consider as a PORI, but how to factor that into the eventual framework is something which we may have to deliberate
Okay.
about.
And let's say if there is, after the conversion, there is a bonus issue, it adds to the problem, right?
Yeah, it does.
It
And
does.
unfortunately, I don't have an answer.
No, I understood that. Thank you. Your Apeksha. Thanks, Nikhil.
Yeah, to be frank, I don't have answer to this question, so I
No,
won't
but
be
that's
able to
okay.
add anything here.
No, it was any which was a hypothetical situation which I was creating.
Okay, I have another call starting in 5 minutes, so it'll be a hard stop for me. Uh, if there are any further questions, my email ID is available and Nikhil's email ID is available with the ICI team. So maybe you can reach out to us over emails, or you can find us on LinkedIn. But you're on mute, huh?
Sorry. So thanks, Apeksha and Nikhil. I think so. We had a wonderful presentation today, and the case studies made it more clear as to how the backsolve method actually works in practical life. They were theoretical examples, but still, it gave a better understanding to everyone about how it needs to be worked about. How do you calculate the threshold break points, and what are the things which you need to be careful while arriving at those break points. So thank you both, and we look forward to having you more in our sessions.
Thank you very much.
Thank you, Apeksha. Thank you, Nikhil.
Thank you,
Thank you.
everyone. Thank you
Thank
for
you.
being a
Thanks,
wonderful
Nikhil, for
audience today.
presenting. Thank you so much.
Thank you. Thank you, everyone. Have a nice day.
Thanks. Bye.
Thank you.
Bye.
Bye-bye. Thank you.